Hey everybody, good to be here today. My name is Brent Moore. It's time for managing an options portfolio, and we do this every week at this time. And I'm glad you're joining us. And I'm joined alongside Connie Hill, helping me out in the chat. Appreciate Connie. And so I encourage you check out some of Connie's webcasts. In addition, you can follow her on X. You can follow me on X as well at Brent Moore CS at Connie Hill CS for additional content throughout the week. I'll be posting a video on X just a little bit later today, just briefly discussing the yield curve, by the way. So, hey, I see some familiar names in the chat. Glad you're here. Thank you for joining me. And if you're watching on a recording, that's great too. Let's go through the few disclosures we have before we get started with the main topic here. Options do carry a high level of risk and are not suitable for all investors. And multiple leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. They don't do that in the paper money application. They don't assign short options early, that is. But in a real account, that does happen. And rolling strategies can entail additional transaction costs. Paper money software application is for educational purposes only. And for the sake of simplicity, I'm not going to factor in commissions in any trades that we do, any sample trades we do, because that's all we do is sample examples. They're not recommendations, but I'm not going to factor in commissions in those, but just realize those are something to think about. Schwab does not recommend the use of technical analysis as the sole means of investment research. All investing involves risk, including potential loss of principal. Past performance is no guarantee of future results. There we go. Let's head on over to the Thinkorswim desktop software. This is the market. Down day in the market. Breaking below that, that's a 50-day moving average, by the way. So we'll see where we end up for the day. It's not the end of the world. I mean, sometimes things don't bounce exactly off moving averages or anything, but it's something to keep in mind, something that some traders look at. But the topic I want to talk about today is, before we get to just general trade management, which we will surely do, but I want to talk about the difference between doing single leg options and doing spreads. And as an example, I'm going to do one that is kind of a common choice that people confronted with, I guess, and that is doing just a short put versus doing a short put vertical, because it's not a right or wrong thing. There's pros and cons to both. Now, for our purposes here, when we're doing short puts, I mean, it's nominally a bullish trade, but keep in mind that you could also kind of consider it a bullish to neutral trade. I mean, if you're gangbusters bullish on something, you very well may look for a different type option strategies, maybe a long call or something like that, or a long call vertical, or a synthetic, or whatever. There's a lot of different choices. But if you're kind of more bullish neutral, and I'm just going to take one that, it struggled. It seems maybe that we had a low, we had a low down here, kind of a low, similar, maybe slightly higher low, little higher lows now. Are we turning the corner here? Our 20's above our 50. We seem to be bouncing. This is Dow Chemical, this is Dow Chemical. So don't confuse Dow with the Dow Jones Industrial Average. But my point is, if you're doing a bullish trade, this is a possibility. My second point is, what we're going to be talking about right now on this, in terms of spread versus single option, doesn't just apply to new trades you're going into. It may apply to existing trades, because you may be confronted with the thought of, should I turn this single option into a spread trade? Okay. Or should I take off a leg off the spread and just turn it into a short put or something like that? That's certainly a possibility there as we look at this. Now, one thing, I kind of deliberately chose a lower price stock here on this. Why? Because if you're doing a short put, you're agreeing to buy 100 shares of stock. So no matter what type of trade you're doing, think about the ultimate consequences. And in this case, if I'm buying 100 shares of stock, it'd be $2,300. For most people, that is much more reasonable than, going out to Tesla or something that is a much more expensive stock there. Okay, but what I want to do is let's just kind of talk about some of the things we may consider on a short put. And I'm going to go through these fairly quickly. Number one, lower price for the reason I just stated. Number two, bullish to neutral bullish, we mentioned as well. Liquid stocks, I don't care what type of option you're doing, what kind of a strategy you're doing. Make sure you have liquid stocks here. We'll look at that a little bit more furthermore. Furthermore, if you're doing a short, just a plain old short put, this is a Vega negative trade. Ideally, you'd want implied volatilities to go down. And so that could be a factor as well. If you turn it into a spread trade, then Vega becomes much less of a consideration because you have long leg, short leg, and to a large extent, they'll kind of cancel each other out. Not totally, but to a large extent, probably there. So let me pull up implied volatility. I'm actually going to pull up a year chart on this. And I want to look back because what we have here is we have, you can see implied volatilities typically go up before earnings. And that is something that is possibly a little dangerous on this. Right now, our IV's about 49 on this. It can go up higher. Now, it can go up a lot higher. One thing when we look at implied volatilities on this is to consider the implied volatility of the overall market. And just for that, I'm just going to use we'll use the VIX here, okay? Because sometimes implied volatilities aren't related as much to the individual stock or aren't driven as much by that individual stock, even though they are on the stock, as the underlying cause is jitteriness on the market here, okay? Notice early April, the whole market implied volatilities went up. In early October, implied volatilities on the overall market got up to like 30 almost. So, and then again in late November. So when you're looking at a graph such as an individual stock, let me go back to Dow here, and we see, oh, look, this spiked. This spike actually, you can see implied volatilities actually went down before earnings here because this was mostly driven by the market as a whole. So I want to take this as kind of an idea of where this is likely to go. It could certainly before earnings, but this wasn't purely an earnings-driven spike. Same thing with early October. That spike was in the VIX here. So it's very likely that implied volatilities may go up a little bit. We're going to be hitting earnings season before too long, come the new year. So fighting against rising against rising volatilities, implied volatilities can be a challenge. But to me, it's not a disqualifier in this case, but it is a consideration in this case here. So what I'm going to do is I want to just first kind of look at a short put here. And I'm just going to go out, to January 9th, which is actually before earnings on this. You can see here is where the implied volatility spike. So I'm guessing our earnings is there. Let me just look real quick. Where is our earnings? January 29th is earnings. It's an interesting spike in IVs there on that one. Yeah, they spike again there. That's where the earnings are. I don't know why. That's a little bit unusual that you see that big a spike there in 1 month there. I'm guessing because it's the monthly contract. I don't know. But I'm going to go to January 9th here. And I'm going to double check liquidity. And I just want to make sure we have a nice tight bid-ask spread. 3 cents. Okay, great. And I can sell this contract for 51 cents. So here's the question. Okay. When we're going to look at this, I want you to think about probabilities. Okay. I want you to think about break-even points, and I want you to think about risk on these trades. So let me just go. I'm going to switch this to, we'll go probability in the money. Well, we'll go probability out of the money, okay? So probability out of the money on the 22, roughly a 65% chance out of the money on this. Well, that's great. We want it to be out of the money. But also consider, where is our break-even point? Because ultimately, we don't need it to necessarily just be above this. Ideally, we'd like it to be above our break-even point. And our break-even point is going to be our premium, which is just, well, if I take a mid-price, we'll say 52 cents. Okay. If I take 52 cents and I subtract that from the strike price, and I'm just going to kind of round and say our break even on this trade would be about 21.50. So that goes into the calculation of whether you want to do this trade. What's the likelihood I think this stock is going to be above 21.50? Okay. And if the answer is, I think it's very likely, and then it may be worth it for you. Here's another thing to consider. What's the premium? The premium is, well, we'll just say about 50 cents here. The stock's about $23, so 1% would be about 23 cents. So we're looking at a little bit of over a 2% return in 23 days' time, okay? But now that all sounds great, perhaps, but there's a downside. The downside is the risk on this. The downside is this could go down, I mean, theoretically, it could go to zero, and we're on the hook for that amount of money. Let's consider a spread instead for a sec. So if instead of doing the 22 just short put, what if we do a 22-21 spread? Let me go vertical. Actually, I'm going to go vertical, 1 month, 2 strike, 2021. So we're going to be looking at this one right here. What happened here? Why am I? One quick sec. That is weird. I don't know why that's giving me a negative value. Oh, I was looking at the 2021, not the 21-22. I was looking at the wrong strikes. Let me do this again here. Sorry about that. I confused myself on that. We're looking at the 21-22. Okay, I'm going to go with the mid price on this. So it's a spread. The mid price is going to be about 23 cents. Okay. So now, instead of that 2% return over 23 days, we have roughly a 1% return over the next 23 days. Right? 23 premium. So our return is less. Where's our break even? Our break even is still going to be our short strike, which is 22, but instead of the break even being at 21.50, it's going to be at about 21.75. I'm just kind of rounding here. I'm just subtracting our credit minus the short strike there. So our break even is higher, which isn't good. So those are some downsides of doing the spread. But there are upsides too. Remember, the total risk on this trade, if we just do a short put, is this times 100. Basically, the amount to buy 100 shares of stock. It'd be roughly $2,200 risk total on this. If I do the vertical spread instead, what's my risk on this? My max loss, my theoretical max loss, is significantly less. Now, you may go, well, that's not even close. It's much less. But the reality is, for most traders, they don't really factor in the likelihood of this going to zero. It can, I can't rule that out, but if we factor in a drop that's a more reasonable drop, maybe the stock goes down to $20 instead of $0, then it becomes a more reasonable question as to which one you want to do and whether you're willing to do the risk. But there's another part to the aspect of this, and that is margin requirements as well. If I look at your buying power on this, my buying power is $77 on the spread. Okay, my buying power is $77 if I do that spread. If I just do that the short put, instead of a $77 buying power, it's a $352 buying power. That's a big difference between those two. So here's my point. My point is, if you were to kind of say pros versus cons of single versus spread, the pro on the single short put is bigger returns, slightly higher probabilities of success. The cons are higher total risk, especially if it really goes down on you, and lower buying power effects on your portfolio. So it's, I don't know which is the right choice for you, but there you go. You can do this. Now, we can always put a stop in on this if we want when you're doing a short put. Stops don't guarantee we're going to get out exactly at whatever the stop price is, but it can help with your money management, and it gives you a way out. But with the short put, remember, you can always do this and say, hey, look, if this goes down, I want to buy the stock anyway. I want to buy it for less than where it's currently at. If I sell this $22 put, look, I'm buying it for a lot less than what the current stock price is at. So what I'm going to do is I'm going to send this trade. Actually, I'm going to throw this in my short puts bucket there. I'm going to send that trade. I'm not going to put a stop in because I'm going to go with the attitude, hey, I'm willing to either roll this or even buy the stock if it drops down lower. Okay? So that's the kind of the first thing I wanted to point out today. When you are considering these trades, consider your pros and cons. And just because something has less total risk, that may not be the entire factor in there of what you're doing, especially if you're dealing with these small, lower priced stocks. It may be a thought, at least. Consider just doing the short put for the higher return and slightly higher probability, willing to take a little bit more risk, but that's totally up to you. I'm not encouraging anybody to take more risk than they feel comfortable with. Okay? Now, there is a survey link in the chat. We appreciate your willingness to take the survey and give us some feedback. And you can always make suggestions, and I try to incorporate most of the suggestions that you make address them, whether it's an individual, whole session, whole webcast dedicated to it, or just at least commenting on it. I'm happy to go through that. Okay. Sometimes when we go through the money management, the portfolio management aspects of this, sometimes I kind of start at the top and go to the bottom, and sometimes I start at the bottom and go to the top because I usually don't get through all of them. I'm actually going to kind of start in the middle today just to make sure that we get those there. Last question, explain the spread again. Sell at 20, buy at 21. Actually, it was the opposite on that. We were selling the 21. We were buying the 20. When you sell the 20, you're bringing in the premium. Excuse me. When you sell the 20, no. It was 22 and 21. We sold the 22. That brings in the premium, brings in the credit. We bought the 21. That cut into the credit, but it helped to protect us on the downside. So that's a short put vertical. And we have a webcast on short verticals that you can always follow. And I forgot when that webcast is, but I'm looking real quick, and I'm probably looking right over it. Short verticals, 2 o'clock Eastern time on Thursdays. You can check that out there again, okay? Short verticals. Okay, let's go here. I'm going to start with CMG, okay? So here's Chipotle. What kind of trade is this? This is a diagonal spread. Different expiration dates, okay? Different expiration dates, different strikes, okay? That is, by definition, a diagonal spread. Now, sometimes diagonal spreads aren't the easiest to understand. So what we can always do is we can always go to the Analyze tab, go to our risk profile, look at CMG, and see where it is. Here's our current stock price, okay, 37 bucks. And you can see we're profitable on this right now. And so we're profitable. It can still get better, no doubt, if the stock goes up a little bit. So if I'm bullish, I may stick with it. Okay? If I'm bearish, we can go from profitable to losing money pretty quickly. So we're going to look at this and see if we're still bullish or if we have turned bearish on it. That's one thing. Another thing is we have a stop on this right now. Let me just click on this. Stop is at $2. Well, look, we bought this for about $3.20 or so. We put in a stop at $2. Okay. How am I get to $3.20? I'm just subtracting the long strike cost. Excuse me, I'm taking the long strike cost and I'm subtracting the short strike on that. Okay. So that gives me about $3.20-ish. Okay. We put in a $2 stop there. Okay. Sounds reasonable. This has gone up though. It's now at about, instead of $3.20, it's now at about $3.50. So we've made a little money, not that much. You can see that right there, our PL open. And so we haven't made such a great amount of money that it's like, I'm going to take the money and run, as long as we're still bullish on this. So let's take a look at CMG. Are we still bullish? Let me go to a shorter term chart. Are we bullish on this? I would say, yeah. I would say from a technical analysis standpoint, okay, from a technical analysis standpoint, we have higher highs, we have higher lows, and we're above our moving averages. And so from this standpoint, I'm going to say still bullish. Now, if you disagree, that's fine. And if you disagree and you think, oh, it's run its course, then we would probably look to exit this trade here. So there we go. That's this. Now, if I want, I can move that stop up a little bit. I'm not going to move it up a whole lot. I can cancel and replace that order. And instead of a $2 stop, maybe we go to a $2.50 stop or something like that. We'll just tweak it up a little bit there. Let me just make sure that you type that in right. Yeah, $2.50. So I'm going to confirm and send. I'm going to send this, try and protect gains that we have in this. And there we go. Okay. So that's CMG. Now, let's bring this up. What happened? I just canceled and replaced the stop, but now it's not showing it there. What probably happened is it went down here. Do you guys ever have that happen? Notice the stop is showing down here, but the trade is showing up here. So the way to get these to sync up is just unallocate this. Go move to group, put this unallocated, and then when I put this back to my, I'm going to move this back to my calendars group. Now it's all going to be synced up right there. Okay. You see that? So it's a little quirk on Thinkorswim desktop that sometimes you just got to deal with, and that's how you deal with it. Fair enough. Okay. Let's look at another one. Another diagonal. This one we're actually doing quite well on. In fact, how much have we made on this? Where's my, I don't know why my percentage gain disappeared on that. Let's add a percentage gain there. PL percent. Okay, let me move this up a little bit. We'll do that. Okay. PL percent, we're up 31% on that. Okay. We're up 31%. That's good. And for some trades, maybe that's not enough. But for diagonal spreads, often we'll say, you know what, we're going to get out if we've made 25 to 50% somewhere in there. So I think that's certainly a possibility. Now, we still have time to go. On diagonals, when the short leg, here we have 30 days till expiration. If that gets, 10 days or less to expiration, we'll probably look to roll it or get out, but we still have plenty of time on that. Let's look at CrowdStrike here. So I'm going to go to Analyze. Notice I'm using, I think the Analyze tab is very helpful on this to visualize these trades. Let me just double check that that's the current price, 476. This is the current price right here. And you can see we're about almost at our peak level where we want it to be. However, we can still make a lot more money, right? That's the difference between the purple line and the blue line. The blue line represents what this trade potentially would look like at expiration. The purple line represents right now. Over time, we'd expect this purple line to get close to the blue line. That's time decay. Theta is on our side on this. So we have a choice. You have a choice if you're playing along at home in your paper money. You could go out and take the money and run, so to speak, get out of it. We have a nice little gain here. Or we could wait and look for that time decay. And we're getting about 12, 13 bucks a day on time decay and let it go. But at this point, I'm just going to take the profit, I think. We've made over 30%. I think that's reasonable. So what I'm going to do is I'm going to cancel my stop order. Another choice is, if we stay with it, by the way, is we could move our stop up. But I'm not going to do that. I'm just going to get out of this. So I'm going to cancel the order. I'm just going to cancel that order. And I'm going to exit the trade. Highlight them, create a closing order. We're going to get out of this. And that's at a mid price. Probably won't fill exactly at the mid price. So I'm going to move up a little bit off that. Confirm and send, and I'm going to send that. And there we're at. That was nice little gain there we had on that. Okay? So that's CrowdStrike. Let's look at Nike. Now, Nike's one that doesn't look very good, right? This is one we've had for a while. We've rolled it out multiple times. We only have 2 days to go till expiration. And I think we have earnings coming up on Nike. Okay? When's earnings? Let's pull up Nike. NKE. Yeah, just in it's like tomorrow. We've got earnings on Nike. So I'm not going to exit this trade just because of earnings. You don't need to do that. This is what we call the poor man's covered call. Okay? And what that basically means is it's not actually a covered call. It's a diagonal spread, but we're kind of thinking of it almost as a covered call in the sense that we're using this leaps call as kind of the base bullish trade. And then what we've been doing is, for several months now, we've been selling calls against it and then rolling them and bringing in little credits along the way. Now, the long call, we're down $1,000 on it right now. We've rolled in, we've brought in credits. We haven't brought in $1,000 worth of credits. We've brought in enough to minimize that, but not totally negate that at this point. But I'm going to continue the process of what we've been doing, and I'm going to roll this out. Okay, I'm going to roll it out about a month. So which are we rolling? We're rolling the December 19th here. And let's look at possibilities here. Let's first look at a chart on Nike. Right now we have a short 72 call. That seems reasonable. Let's look at the problem. Let's just do this. Let's go to Nike. Let's go out about a month. We'll go out 30 days. And if I go, there's no 72, but there's a 72.50. If I sell this, the delta is about 26. That tells me how much this option is going to move in relationship to a $1 move in the stock price. It also tells us, kind of gives us a sense of the probabilities of it being in the money. It's not exact. This would imply about a 74% chance of it being out of the money. Well, this measure is giving a 78% chance of it being out of the money. So in any case, what I'm going to do is I'm going to look at this. Now, if you're doing this trade, I often will look around the 30 delta here. For that reason, just the probability out of the money type thing. Sometimes we'll go a little bit lower. Well, this is a little bit lower. Can we go lower yet? Can we go to the 18 delta? Yeah, we sure can. That means there's less likely this is going to go in the money, which is what we don't want it to do necessarily from this standpoint. Although if it does, it means the long contract would be doing pretty well. But our premiums are a lot less on this. So if you want to take maybe more of an approach where it's less likely to go in the money, willing to take less money on it, then maybe you'd go out to this strike, the 75 strike. But I'm going to go with the 72.50 strike. Because, number one, it's going to bring in a bigger premium. Number two, it's still probably not going to be in the money, 26 delta. And number three, if the stock goes up to 72.50, that means that this long call is probably going to be doing much better, look much, much better than it does right now. I don't know if that will be showing profitable at that point or not, but it'll be looking a lot better than it is. So there we go. So I'm going to roll this. I'm just going to right click on this. And remember, when you roll, I'm just going to click create rolling order. Okay. And we're going out to the January contracts, and we said 72.50. By the way, before I click on that, notice I went to 72. It says not traded. Well, that's because there is no 72. There's a 72.50. It gives you a little other note right there. So if I change this to 72.50, it should give us something here. There we go. There's our 60-cent credit, okay? Or $60 for the contract. So that's rolling. Now, could I also just buy this one back and sell this one as a separate transaction? I sure could. It's still effectively doing the same thing. By doing it in this one order ticket, I'm doing it in one order ticket. It doesn't save me commissions. It's just kind of doing it in a one order ticket. One kind of nice thing, if I do it this way, is, I'll show you in just one sec, is it makes reading the screen a little bit easier probably when I go to my account statement and I look at Nike, which I actually have up here already. Notice it gives it to me right here. That was the amount of the roll. Okay. Otherwise, I'd kind of have to do math here on this. Okay. And let's see, what do I got? I don't even know what that is. Oh, I think I let the last contract expire. So this one wasn't a roll. This was just a credit, 123 credit, 52 credit, $85 credit, 156 credit. This one, though, it kind of illustrates it. This one was, we put it as two different trades. We bought this one for 6 cents. We sold this one for 88 cents. So that's an $82 credit, not including commissions there that we brought in. And so when I say these are kind of whittling away at the cost, the loss we're seeing on the long call, that's what I'm talking about on that. It doesn't make up for it, but it does. It is kind of working there. It's kind of helping on that. So that's Nike. And we did that roll there on that. So there we go. Let me just double check time. We're doing okay on time here. Now, here's a trade that isn't looking so hot right now. Apple, okay? What we did was, what kind of trade is this? Look at this. This is a long call vertical. Same expiration date, so it's a vertical spread. Different strikes. We're buying the lower strike. We're selling the upper strike. That's a long call vertical. If we buy the lower strike, it's bullish. If we sell the lower strike and buy the upper strike, which would be the opposite of what I actually have here, then that would be a bearish trade. This trade is called a long call vertical, or also known as a bull call spread. Those terms are synonymous, so you may hear it either way. But let's look at what happened to Apple. We did this trade on November 25th. It was a bullish trade. It was kind of more of an aggressive bullish trade. November 25th, Apple. See what happened. Where's November 25th? Come on, get out of there. November 25th was right here. And at first it was looking good, and then it just reversed on us. And now it's not looking so hot, is it? In fact, we've kind of broken down below. And look, we could move a stop up and say, this looks like it may be bouncing. But one of the rules that we've always used in this class is, look, once we're getting under 10 days to go to expiration, we're just going to close it out. So it's unfortunate. We're losing some money on this one, but we're just going to take it. We're going to not see it get any worse for us, because this certainly could get quite a bit worse than where it's at right now. So I'm just going to create that closing order. I'm going to get out of this, confirm and send, Okay, so you know what? You win some, you lose some. That was a loser. Let's look at another trade, one that we've looked at a lot in the past, but things are changing a little bit on this. Let's look at Caterpillar. Caterpillar, I just have a leaps call. Okay, leaps call. You go, well, it's looking really good. Yeah, it is really good. And you know what's even better? This was actually a roll where we rolled it before and did quite well on it before. If I go to Caterpillar and go here, let me refresh myself. This is a 450 January, gosh, come on. A 450 call. And so we rolled this from the 330. Originally, we bought this for about $7,000. Okay. We then sold it for about $16,000, buying a new one for about $8,000. In other words, we rolled it for about $8,300. Do you see so these are the individual trades. This is what I was trying to tell you earlier. This tells me the roll value on this. Okay? And so that was really nice. And these up here are different trades. So this is just a vertical spread or something I have up there. Okay, so we're not looking at those. So in other words, what we currently have, the PL Open reset back then. But look at this. This is just not looking good. We lost $2,200 today. This was almost at, what's it, 8, 9? This was almost at a 10,000 PL Open since the roll on this. So do we stick with it is the question. Well, we have some choices. One, if we're bearish on this, if we're truly bearish, we're probably just going to get out of it. Okay, this is, yeah, Cecil pointed out today that is not a good look on Caterpillar. We can look for this to bounce here, and I think that's reasonable. I don't think we necessarily need to say this is a bearish point where we need to get out at this point, but maybe we reevaluate that stop and tighten that stop in case it continues to go down. So let's look at this. So here's our stop. Our stop's at about 125. What's the current price on this? The current mark on this is about 155. So we're getting a little closer to that stop anyway. So I'm just going to tighten that up just a little bit, not too much. I'm not going to go to 150 or anything. I'm going to give it a little wiggle room because I want to give this a chance to work. But I'm just going to right click on this. I'm going to cancel and replace that order. I'm going to move this 125 stop up. I'm just going to move it up to 130. Okay. Not that much, but that's a $5 difference or $500 difference. Okay. Okay. Now, there's a good question. What about taking off half? Well, let's go back here. Clicked on the wrong thing. I can't take off half. I only have one contract. But you're right. If we had two contracts, Scott, absolutely, that's a very smart thing to consider doing. And I'm glad you brought that up because it's absolutely a consideration there, taking off half on that. Okay, let's finish up with one more, and then we'll probably call it a day here on this. I have another trade, Warner Brothers. They've been in the news a lot lately, okay, with the Paramount and Netflix news and whatnot. This has been doing very well. This is just a long call. I got 30 days, so no urgency to get out. We could take a profit. We could get out half of the contracts per Scott's suggestion on that. That would certainly make sense. Let's take a look at the chart there, though, and just kind of get a sense for this. WBD, okay? And going up, kind of flagging here. I don't want to lose too much. I could certainly take off half. I could also look at our stop, which is at 125, which made sense when the trade was 214 when we got in it. Well, now it's $6. We can move this up significantly here. And so I'm going to move. I am going to move this up significantly. I'm going to move this up above $4 here. Okay. So I'm going to right click on this. I'm going to cancel and replace this order. I'm going to move this stop up. I'll go to 425. Okay. $4. If I moved it to $4, that would be a stop. It's a $6. Current price is $6 on this. Hold on. Move this. Where are we? Here we go. Current price is $6 on this right here. $4 would be about a 66% stop loss, which is, I don't want to go much above that. So I went just a little bit above that. I went to 425 on the stop there. So we moved that stop. Now, Eric said, take the money and run. I don't think that's a bad idea. That's why we moved up the stop. Certainly, we can also get out of half of this. I think that may be that. How much time we got? We got to get out of this. What I'm going to do is, let's do it. Let's get out of one of those contracts. I think that's a reasonable approach. Okay. So I'm going to sell one of these contracts and confirm, send. Now, what did I just do? I just got out of it. What's my stop? I still have a stop on two of those. I've got to change that stop so there's just one contract now. There we go. Okay. Awesome. Okay. We took the money and run, so to speak. That's what Will was referring to there in the chat. Yes, absolutely. That was a nice little trade, and we're still in it. We'll stick with part of it and manage going forward. Everybody, thank you for joining me today. I appreciate you, and we will encourage you to subscribe to the Trader Talks channel. Coming up next, we have trading price patterns. And by the way, I will be subbing for Ben Watson today in the Trading Index Options webcast. We do have a survey, and we appreciate you filling that out. Thank you, Connie, for helping me out in the chat. Everybody, have a great rest of the day. Bye-bye, everybody.